Good afternoon, everyone. It's Greg Kojak. Today is Monday, March 9th. We continue to see downward pressure, volatility in the markets. Just want to take a couple minutes, probably 6 or 7 minutes to talk about it. But it's not about coronavirus, so that's probably why it's a little bit confusing. It is about crude oil, and there's a bit of a spat between OPEC partners. So it's added to some of the volatility, causing circuit breakers to pop off, and obviously a lot of media attention. So the first thing that I want to just quickly say is, by now most of my clients have heard from me personally via phone call or email, and I'll say the majority of clients are calm. They're introspective and look at these things objectively. But I do kind of see a trend towards people being a little bit more anxious, only because of the longevity, the duration of this volatility is going on several weeks and probably over a month now. So people are just in general seeing this as a little bit of a longer term volatility stretch, which is true. And I do think that there's a probability that it will continue on for at least a quarter, and some analysts are predicting 2 quarters. So definitely keep that in the back of your mind. But all in all, most people are keeping a cool head, and as we all know, cool heads prevail in these types of situations. So crude oil, it might be a little bit murky and confusing, because the United States is actually the largest crude oil producer on the planet, and this is all according to the U.S. Energy Information Administration. So they've got the website, you can look it up. The number 2 largest producer is Saudi Arabia. Number 3 is Russia. So when number 2 and number 3 added together is larger than number 1, the United States, and if they start to have a disagreement on prices and volumes, you're going to see this kind of volatility. The only problem that we're seeing, and the effects that we're seeing, is the U.S. is by far the largest consumer of crude oil, so it is spilling out into our markets and affecting companies. So I just want to put that in perspective and show you a quick chart and go through volatility and panic attacks, and show that really doesn't make a lot of sense to sell now and think that going to cash makes a lot of sense. So I'm going to do this, and hopefully I can give a little bit of, you can kind of see my computer screen, and this is a little bit old school, I know that much, but it's kind of the easiest way for me to do it. So in this chart, we're going to look at classic panic attacks and kind of the markets. So this is the MSCI ACWI, which is basically the world index. We're talking about developed countries like the United States and the EU, and developed countries as well as emerging countries like China and most of Asia as well. So going back to 2015, we see that, we can go as far back as when Greece was talking about an exit. We can see that here in mid-15, the oil price falls, the dollar rises. Mid to late 15, you've got the yuan devalued and ETF crash, flash crash, where there was about 1,200 different instances of circuit breakers popping off for like 400 plus securities, stocks and ETFs. Third Avenue blew up at the end of 15. Crude oil bottoms out beginning of 16. Japan goes into negative interest rate environment early 16. Brexit, rate hikes, and again, this is 16, 17. This is the Trump impeachment scare. Mid-17, North Korea crisis, where they were launching more nuclear weapons and threatening. 2018, short volatility unwind. We saw a drastic drop in the market. Trade war escalations. Italy, which is Italy talking about leaving the EU. Fed communication error causing a significant drop in the end of 2018. The U.S. government shutdown in December of 18. Trade war accelerates, so on and so forth. So looking at this entire time frame going back to 2015, so it's about 5 years, 21 different panic attacks, so to speak. And you can kind of see where these panic attacks happen and the downward trend of the market. But as you can see that, almost quickly thereafter that the, markets rebound and this global index rebounds because, I'll go out and say that because the market overreacts. They tend to sell too quickly, too fast because of unknowns, because of these, quote, panic attacks. Once they unveil themselves and data is being produced, they quickly start to reverse themselves and try to get back on track, mostly based on fundamentals. The other thing that I keep handy right on my desk here on the corner, I don't know if you can see it, is my little book of behavioral investing, How Not to Be Your Own Worst Enemy, James Montier. So great book. It's been on my desk, on the corner of my desk for years now. And during weeks like this, I kind of turn towards it and remind myself. 2 more quick slides. So the effect of the panic attacks, we can go back for 20 years and you can kind of see, I'll try to zoom in, 20 years of annualized returns from 99 to 2018. And you can see REITs, gold, US stocks, government bonds, international equities, homes, inflation, and the average investor. So what this shows is the average investor who kind of tends to get spooked like the markets and probably sells too early, unfortunately pays the price by not staying in and not getting the rate of return that some of these other categories get. So you want to, prevent yourself from being your own worst enemy and stay within the parameters of the market and stay invested, even though your gut might be telling you to get out because you're unsure of how it might turn out. The last thing I want to point out, and I have to skip ahead quite a few slides, so I apologize for that, is the actual effects of missing the best days in the market, which follows the worst. So here, this slide is going to show us per decade, and it shows us the 1930s, the 40s, 50s, 60s, 70s, 80s, 90s, 2000s, 2010 decades. And then if you stayed in the entire decade, this is your price rate of return over here. And then if you missed the 10 best days, best positive trading days in the market per decade, your rate of return, which is kind of synonymous with that investor return. The results are drastic and unfortunate for those that decide to pull out at exactly the wrong time. So the price return on average is 114% when you average all these decades together. And the average, if you take out those 10 best trading days per year, and again, think about that for a second. So if it's a decade, that's 10 years, and you just decided to miss the one best day per year. You pulled out and forgot to, or didn't feel confident going in on the exact best day. It's about 100% difference. In this case, it's a little bit less, but like I'll take this 2010 time period, the past decade that we just went through. If you just stayed in, you got 190%. But if you missed those 10 best days, you got 95%. So that's 100% difference that you missed out on. And again, looking through these decades, it's a similar story. Sometimes it's not quite as drastic, but all in all, the point is clear that, if you think that you're going to time it well and you're going to be perfect, think again, because you're probably not going to feel confident, or you just, life got ahead of you and you just decided not to invest. So stay the course. We also want to reiterate that. And I will say that, we are going through unprecedented volatility. It's longer than we've ever seen before. So don't panic. Think about your investments on a longer term basis. Hopefully you don't need all of your money within the next quarter or two as we kind of sift through all this and see where we're going and how it's going to affect our economy and stocks. But please also call, email me. It always helps to talk it through, communicate so we can kind of disseminate what you're thinking and where you're getting your information, and also bring some more perspective back to where you should be for the long term. I hope that helps. Feel free to contact me. Thanks.